right now, central banks around the world are just quietly hoarding physical gold, like at the absolute fastest pace we've seen in modern history.
Yeah, it's honestly unprecedented.
Right. And meanwhile, the U.S. government is sitting on, what is it, like $38 trillion in national debt?
Roughly, yeah. 38 trillion.
Which is just an keeps touching all-time highs. Like everything is fine.
Right, the surface metrics look incredible.
Exactly. But someone, somewhere, is lying. Or, at least the math just isn't mathing anymore.
The math is definitely breaking down.
So today, we're looking at why Austrian economist Dr. Mark Thornton believes the global financial system isn't just, bending right now. It is actively breaking.
And it's a structural break, not just a temporary dip.
Welcome to the deep dive. We are unpacking an incredibly dense and, frankly, highly concerning interview with Dr. Thornton today.
It's definitely a heavy one.
It is. And our mission today for you, the listener, is to really examine this massive, flashing red warning light that's going off in the global financial plumbing.
Because if you just watch the mainstream financial news, you're entirely missing it.
Right. We're dissecting why gold and silver prices are just violently surging, what this signals about the structural integrity of the U.S. dollar, and how the underlying machinery of the global economy might just be fundamentally compromised.
It's a critical moment to examine this, really, because most people are, they're entirely focused on surface-level metrics, right?
Like the GDP.
Exactly. They look at a headline GDP number, or they see the S&P 500 is up, and they just assume the foundation of the economy is totally solid.
Because that's what we've been taught to look at.
Right. But Dr. Thornton is arguing that if you look at the deeper systemic markers, like the expansion of the M2 money supply, or this exponential curve of sovereign debt, and just the literal panicked movement of physical metals into sovereign vaults, the patient is actually in critical condition.
Yeah, the patient is on life support. But before we get into the weeds on the monetary plumbing here, I do want to offer a really quick contextual disclaimer for you listening.
Always a good idea with this kind of material.
Right, because the source material we're pulling from today, it contains some pointed perspectives. Dr. Thornton and his interviewer, they delve into the actions of the Federal Reserve, this sociological concept of government, quote-unquote, power elites, and even the stated policies of political figures.
From President Trump to new financial appointees, yeah.
Right, people like Scott Bessent and Kevin Warsh. So our goal today is just to neutrally explore the economic mechanics, right? The historical precedents and the market theories presented in this interview.
We're looking at the math.
Exactly. We are not here to endorse any political side or validate any specific conspiracy theories. We're just here to rigidly examine the ideas and the raw data that Dr. Thornton is putting on the table.
Which, honestly, is the only rigorous way to approach macroeconomic theory anyway. Because regardless of your political leanings, the mathematics of compounding sovereign debt or the historical life cycle of fiat currencies, these are objective realities.
They don't care who you voted for.
Exactly. They dictate the purchasing power of your savings, whether you agree with the policymakers or not.
Okay, let's unpack this. To really grasp why gold is acting like a siren right now, we have to look at the asset it's explicitly pricing itself against.
The U.S. dollar.
The dollar, yeah. Thornton outlines what he calls a dual crisis for the dollar. We're watching a simultaneous collapse in global demand and an absolute explosion in supply.
At the exact same time.
Right. So let's start with the demand side, because the geopolitical tectonic plates are visibly shifting away from U.S. Treasuries.
And they have been for a while, but it's accelerating.
For decades, the undisputed safe haven asset for any foreign central bank was just a U.S. Treasury bond.
It was the bedrock of global finance.
But Thornton highlights a drastic, really aggressive pivot. Central banks are dumping treasuries, and they're buying physical gold at a rate we honestly haven't seen since the Bretton Woods era.
The numbers are just a total paradigm shift. The source notes that gold now makes up more than 50% of total central bank assets and reserves globally.
Wait, over 50%?
Over 50%.
That's massive.
It is. That is not a marginal reallocation of a portfolio. That's a fundamental repudiation of sovereign fiat debt.
Wow.
And we have to look at the geopolitical mechanics driving this, right? Because for decades, the global economy functioned on this implicit trust that the U.S. dollar was just a neutral settlement layer.
Like it was just the rails that commerce ran on.
Exactly. Yeah. But the weaponization of the SWIFT system and the freezing of sovereign reserve.
Oh, like with Russia.
Right. Whether it's Russian assets recently or Venezuelan gold before that, that sent an absolute shockwave through the Global South and the BRICS nations.
I mean, I'd be spooked too.
You have to be. If you are a foreign central bank, you suddenly realize that holding your national wealth in a digital ledger controlled by the Federal Reserve carries immense counterparty risk.
So the dollar kind of ceases to be money and becomes like a geopolitical leash.
That is exactly the sentiment driving this shift. A U.S. Treasury bond is just a promise to pay, right? And it's entirely contingent on the goodwill of the U.S. government.
Whereas physical gold
sitting in a vault in Beijing or New Delhi has zero counterparty risk. It cannot be frozen, it can't be sanctioned, and it cannot be deleted by a foreign power.
Yeah, that makes a lot of sense. But it's not just at the institutional level, right? Like Thornton points out that individual retail demand for the U.S. dollar is plummeting globally, too.
Yeah, the citizens are catching on.
He specifically notes people in India, China, and Turkey aggressively buying physical precious metals. Like they're essentially front-running their own central banks.
Which is fascinating.
They're choosing to hold wealth entirely outside the dollar-dominated fiat system.
Yeah, they're looking at their local currency inflating, they're looking at the dollar weaponized, and they're just opting out.
Which brings us to the supply side of the crisis. Because while the globe is systematically rejecting the dollar, the U.S. Treasury is just flooding the market with new issuance.
Right. The printing presses are running hot.
The source cites the U.S. national debt at an unfathomable $38 trillion.
Which is a number so big the human brain can't even really process it.
It really can't. And it's not an isolated phenomenon. Thornton notes similar sovereign debt crises brewing in Britain, in France, and Japan.
It's a global fiat sickness.
Governments are just running these structural deficits that require constant, massive bond issuance just to keep the lights on.
And we have to contextualize that $38 trillion against the actual economic output that supposedly supports it, you know?
Right, the GDP.
Exactly. Historically, a U.S. national debt hovering around maybe 30% of GDP was considered the sweet spot.
Like manageable.
Very manageable. It's enough debt to lubricate financial markets with safe collateral, but it's easily serviceable by the tax revenues of a growing economy.
So where are we at now?
The source notes the U.S. is now sitting at roughly 120% debt to GDP.
Good grief.
Yeah. And long-term macroeconomic studies of fiat systems, they indicate that crossing the 100% threshold is historically the point of no return.
The point of no return.
Thornton argues this is mathematically the on-ramp to hyperinflation.
Okay, but wait, I do have to push back on that 100% point of no return thesis.
Sure.
Because if we look at Japan, right, their debt to GDP ratio has been hovering over, 250% for years?
Yeah, well over 200.
And mainstream financial media constantly uses Japan as the prime example that sovereign debt just doesn't matter as long as you print your own currency.
Right, the modern monetary theory argument.
Exactly. They haven't seen hyperinflation. If anything, they've been fighting deflation for decades. So why is Thornton so sure the U.S. crossing 120% is this apocalyptic, irreversible tipping point?
It's a great question.
Like, are we sure he isn't just leaning into some, Austrian economics fear-mongering?
It's a really vital counter-argument, but the internal plumbing of the Japanese economy is entirely different from the United States.
So?
Well, Japan's debt is almost exclusively held domestically by its own citizens and its own institutions, and it's funded by historically massive domestic savings rates.
Oh, so they owe the money to themselves.
Exactly. Furthermore, Japan runs a current account surplus, meaning they export more than they import.
And the U.S., not that.
The United States is the exact opposite. We run massive structural trade deficits. We rely entirely on the rest of the world to absorb our debt to fund our consumption. So if foreign central banks stop buying our debt, which, as Thornton just pointed out, they are actively doing by pivoting to gold, the U.S. Treasury has no domestic savings pool large enough to absorb the bond issuance.
So the buyer of last resort just becomes the Federal Reserve.
And that is the hyperinflationary trigger. When the open market refuses to buy the debt, the central bank has to monetize it directly.
They just buy it themselves.
Right. They expand their balance sheet, they digitally print the money, and they buy the Treasury bonds themselves. And the catalyst for this isn't even necessarily the principal amount of the $38 trillion.
It's the interest.
It's the interest expense. Thornton points out that the interest payments on the U.S. debt are going exponential right now.
Because rates went up.
Exactly. The Congressional Budget Office projects that within 8 years, the interest payments alone will exceed all defense spending and all discretionary spending combined.
Wow. Wait, so if we connect this to the bigger picture, you're saying the government will be spending more capital just servicing the yield on past debt than it spends on the military, infrastructure, and education combined.
Every single year.
Yes. And that CBO projection, I mean, that likely assumes an optimistic scenario of like 2% inflation and steady growth.
Yeah, absolutely. It assumes everything goes perfectly.
So if we hit a recession and tax receipts fall, or if inflation spikes again and bond yields rise, that interest expense just goes totally parabolic.
Which forces a vicious cycle. You have to literally issue new debt just to pay the interest on the old debt.
Okay, let's use a mechanism to visualize this for the listener rather than the old cliche of a consumer maxing out a credit card, because I feel like people tune that out.
Yeah. Macroeconomics is different than household finance.
Right. So think of the U.S. government like a massive legacy corporation. Let's call it USA Inc.
Okay, USA Inc.
For years, USA Inc. has been doing these aggressive stock buybacks to keep its share price looking incredibly high, and it funded those buybacks by issuing high-yield corporate junk bonds.
Right, borrowing cheap money to pump the stock.
Exactly. And for a while, the shareholders, like the tech sector, the asset owners, they're thrilled. The stock is soaring.
Everyone feels rich.
But eventually, the bondholders realized that USA Inc. actually produces very little of actual value anymore. Like, its manufacturing base is hollowed out.
They look under the hood and see there's no real revenue growth.
Right. So the bondholders demand higher and higher interest rates to keep lending money. And eventually, the interest payments on those junk bonds consume 100% of USA Inc.'s operating revenue.
The profit margin goes to zero.
Yep. So the only way the company avoids default is by issuing billions of new diluted shares of stock just to pay the bondholders.
That dilution is the exact mechanism of currency debasement.
Right.
Every single new dollar printed to service sovereign interest mathematically steals purchasing power from all the existing dollars in your bank account.
Right.
And the global market knows this.
So if sovereign wealth funds and central banks and retail investors in the East are looking at this compounding debt spiral and deciding to front-run the currency dilution, where exactly is that capital flowing?
Well, Thornton points to gold.
But why is gold reacting so violently? I mean, why not just buy real estate or blue chip stocks?
Thornton attributes this to the fundamental economic principle of inelasticity.
Inelasticity.
Right. The supply of physical gold is hyperinelastic. You cannot simply adjust a spreadsheet to create more of it, no matter how high the price goes.
Okay, break that down for me.
Let's look at the actual mechanics of the gold mining industry. Finding a viable deposit, securing the geopolitical permits, conducting all the metallurgical studies, and then actually building the physical infrastructure to extract microscopic amounts of gold from ton after ton of rock.
It takes forever.
It is a process that typically takes 10 to 15 years.
Wow, 10 to 15 years.
And the capital expenditure is astronomical. So if global demand for gold spikes tomorrow, like we're seeing right now with central banks, the mining industry literally cannot increase the supply to meet that demand for a decade.
Because the supply is geologically bound, you can't keystroke it into existence like a currency.
Exactly.
It's totally agnostic to the desires of the Federal Reserve.
Right. And the existing above-ground supply is very tightly held. So when you have massive new entrants into the market, like those central banks we discussed, bidding for a rigidly fixed physical supply, the price discovery has to resolve violently upward.
It's just supply and demand 101.
It is. Even a slight pause in central bank accumulation might cause a little short-term price dip, but the macroeconomic trend is locked because the physical constraints are permanent.
Now, here's where it gets really interesting.
Yeah.
The source points out an entirely new demographic that is pouring capital into this inelastic asset class right now. And it's not the traditional gold bugs or the sovereign wealth fund.
Oh, great.
It's the crypto demographic.
This represents a massive sociological shift in capital allocation, really.
It totally does.
Because for the last decade, the younger, highly technical, really risk-tolerant demographic looked at the debasement of the U.S. dollar and they sought an exit.
Right. They saw the inflation coming.
They naturally gravitated toward the digital scarcity of Bitcoin and the broader cryptocurrency ecosystem. They were seeking decentralized, private money that couldn't be inflated by a central bank.
The cypherpunk ethos.
Exactly.
Like, they correctly diagnosed the disease of fiat currency, but they opted for algorithmic scarcity rather than physical scarcity.
And for a long time, that siphoned a tremendous amount of monetary energy away from the precious metals market, which actually kept gold prices relatively suppressed.
That makes sense.
But Thornton notes that following the semi-crash of the crypto markets, The extreme volatility, the exchange collapses like FTX,
Yeah.
the realization that digital assets are still highly correlated to tech stock liquidity cycles.
They move right along with the NASDAQ.
Exactly. So this demographic is pivoting.
Mm.
They still want hard money, but they are recognizing that the 5,000-year historical track record of physical gold offers a baseline stability that code just cannot yet replicate.
So you have a digitally native, highly liquid generation actively crossing over into the physical bullion market.
Which acts as a massive demand shock on an already inelastic supply.
And the source highlights a stunning disparity here. It describes the U.S. retail ownership of physical precious metals as, quote, teeny compared to international counterparts.
It's almost non-existent.
While citizens in China and India view gold as this foundational layer of family savings, the average American investor is holding essentially zero physical metals.
Zero.
They are entirely exposed to paper assets, stocks, bonds, 401ks, and all of it is denominated in a currency that is actively being diluted.
Right.
It feels like the American middle class is completely blind to the lifeboat that the rest of the world is boarding right now.
Well, it's because the American public has suffered from the ultimate normalcy bias.
Normalcy bias.
Yeah. We have enjoyed the exorbitant privilege of having the global reserve currency since World War II. We've never had to experience the hyperinflationary collapses that have completely wiped out middle-class savings in places like Latin America or Eastern Europe.
So we just assume it can't happen here.
Exactly. The cultural muscle memory of holding physical gold simply atrophied in the U.S. But Thornton points out that geopolitics is acting as an accelerant that is forcing the issue globally now.
Right. The source outlines a whole litany of geopolitical flashpoints: aggressive U.S. tariffs, diplomatic interventions in Venezuela, posturing regarding Greenland, massive trade friction with China, and kinetic posturing against Iran.
It's a very fractured world right now.
Thornton argues this is actively fracturing the globe into localized trading blocks.
And that changes the whole monetary equation. When global trade was heavily integrated and relatively peaceful, the efficiency of using a single fiat currency, the dollar, it outweighed the risks.
It was just easier.
It was easier. But the moment the U.S. begins utilizing the dollar as a geopolitical weapon, the calculus changes for every nation on Earth.
Right.
If you are a rising power in a competing trading bloc, holding your wealth at U.S. treasuries is a massive strategic vulnerability.
They can just turn it off.
Right, so gold becomes the ultimate non-sovereign, trustless settlement layer. It doesn't require the permission of the U.S. Treasury to transact.
It's permissionless money.
Exactly. As these trading blocks solidify and look to settle trade outside the dollar system, their demand for physical gold as a Tier 1 reserve asset becomes an issue of national security, not just an economic preference.
Okay, so the geopolitical stage is set for a dollar crisis. The debt is spiraling and the world is hoarding gold. But if you look at the domestic U.S. economy, the headline numbers tell a completely different story.
A paradox.
Right. The source notes that the U.S. gross domestic product is purportedly growing at 4%.
Which is huge.
For a developed economy, 4% growth is massive. Yet, in the same breath, the source cites staggering layoff numbers. 108,000 layoffs in January alone, which is the highest since 2009.
Just brutal numbers.
Amazon cutting 16,000 workers. UPS slashing 30,000 jobs. I mean, how do we reconcile 4% economic growth with literal blood in the streets of the labor market?
This contradiction is actually the core of Dr. Thornton's analysis, and he relies really heavily on the Austrian business cycle theory to explain it.
Okay, lay that out for us.
To understand why tech giants and logistics companies are mass firing workers while the GDP looks robust, we have to look at how central bank policy distorts the foundational structure of the economy.
Let's dig into that mechanism. Austrian business cycle theory. That originates with Ludwig von Mises, right?
Yes, primarily his work around 1912 on the theory of money and credit.
Which, amazingly, later accurately predicted the 1929 crash.
He saw it coming when no one else did.
Mises argued that boom and bust cycles aren't an inherent flaw of free market capitalism, but they are the direct, unavoidable consequence of central banks artificially suppressing interest rates.
That is exactly the mechanism, because in a truly free market, the interest rate is essentially the price of time.
The price of time.
Right. It is determined by the pool of real savings in the economy.
Yeah.
If society saves a lot of money, the pool of capital is large, and interest rates naturally fall.
Supply and demand.
Exactly. And that signals to entrepreneurs that it's safe to undertake long-term capital-intensive projects. because the savings are there to back it up.
But when a central bank like the Federal Reserve forces interest rates to near zero and they just print trillions of dollars.
They create a massive illusion. They send a false signal to the entire corporate world that there is this huge pool of real savings ready to fund expansion, when in reality, it's just printed fiat.
So the cost of capital becomes essentially free.
Right.
And when money is free, corporate behavior changes drastically.
It creates a phenomenon Austrians call malinvestment.
Investment.
Yeah. The artificially cheap credit doesn't just flow evenly across the economy. It flows heavily into what Austrians call the higher stages of production.
Like what?
Advanced technology, artificial intelligence, massive infrastructure projects that won't actually yield consumer products for a decade. Thornton uses the current AI boom as the perfect example here.
Oh, that makes so much sense.
Because borrowing costs were near zero for so long, companies like Amazon and Google could borrow billions to hire legions of engineers and build massive server farms for projects that might not be profitable for 10 years.
But the illusion eventually breaks.
It always does.
Because the central bank didn't actually create real resources, right?
Yeah.
They didn't create more steel or more concrete or more engineering talent. They just printed paper.
Exactly.
So all these companies take their newly printed cheap money and they start bidding against each other for the exact same limited pool of labor and raw materials.
Which inevitably causes massive price inflation. And when that inflation finally registers in the broader economy, when the cost of living explodes for everyday people, the central bank is forced to panic. They have to rapidly raise interest rates to fight the inflation they themselves created.
And this is where the layoff mechanism kicks in.
Right here.
Suddenly, the cost of capital for Amazon or UPS isn't 0% anymore, it's 5% or 6%. Those massive 10-year R&D projects that only made mathematical sense when money was free, they are suddenly financial sinkholes.
They're completely unviable.
The companies realize they're overextended. They have to instantly amputate those divisions just to survive the new high-interest rate environment. So they abandon the projects and they mass fire the workforce.
That is the boom and bust cycle playing out in real time.
Yeah.
The 4% GDP growth we see, that's just a statistical residue of the massive debt-fueled spending spree.
The hangover.
Right. The layoffs are the painful realignment of the economy back to actual reality.
I think the best analogy here for you listening is the concept of a systemic sugar rush.
Oh, I like that.
If you artificially suppress interest rates, it's like injecting the economy with a massive dose of pure glucose. The brain of the economy, like the venture capital firms, the tech monopolies, the stock market, it gets the sugar first.
Yeah, and it feels euphoric.
Totally euphoric. It vibrates with energy, and the headline metrics look like the body is performing at Olympic levels, but it's empty calories.
Right.
Down in the muscular and skeletal system, the manufacturing sector, the working class, the logistics networks, the body is actually starving for sustainable nutrients.
It's hollowed out.
Eventually, the blood sugar spikes, the insulin resistance kicks in, which is inflation, and the system crashes violently. The tech sector is forced to shed the excess weight, resulting in those 108,000 layoffs.
And that biological disparity perfectly mirrors the K-shaped economic recovery that Thornton discusses in the interview.
The K-shape.
Yeah, the letter K is the perfect visual. You have one line skyrocketing upward and another plunging downward. The defining characteristic of a fiat monetary system is what's known as the Cantillon effect.
Richard Cantillon, right.
Yeah. Yes. He observed in the 18th century that when new money is created, it doesn't distribute evenly across the population. The people closest to the printing press, the banks, the private equity firms, the tech elites, they get the money first.
They get to spend the newly created dollars before prices have adjusted upward.
Exactly.
So they use that cheap debt to buy hard assets,
Yep.
real estate, equities, fine art. So their net worth absolutely explodes. They ride the upward arm of the K.
Meanwhile, the working class, the people who actually rely on hourly wages and fixed salaries, they ride the downward arm.
Because they're last in line.
Exactly.
Right.
By the time that newly printed money circulates through the entire economy and finally reaches them in the form of like a minor wage increase, the cost of housing, groceries, and energy has already skyrocketed.
Their purchasing power is decimated.
The system structurally transfers wealth from the wage earner directly to the asset holder.
So if the working class is being completely hollowed out by inflation and the government is drowning in $38 trillion of debt with compounding interest, the central bank is backed into a terrifying corner.
They are trapped.
They can't keep interest rates high without bankrupting the Treasury and causing a massive corporate depression. but they can't lower rates without reigniting hyperinflation.
Pick your poison.
This leads us to the ultimate desperate monetary tool discussed in the source, yield curve control.
Yield curve control, or YCC, is really the financial endgame for a heavily indebted sovereign.
Okay, let's explain how this works.
To understand it, we have to look at the mechanics of the Treasury market. The Federal Reserve easily controls the short end of the yield curve, like the overnight borrowing rate for banks.
The federal funds rate.
Right. But the long end of the curve, the 10-year, 20-year, and 30-year Treasury bonds, those are traditionally dictated by the free market.
By actual investors.
Yes. Bond investors assess the long-term inflation risk, and they demand an interest rate that actually compensates them for tying up their capital for 3 decades.
Right. If I think inflation is going to average 5% over the next 20 years, I'm absolutely not going to buy a 20-year Treasury bond that only yields 3%.
You'd actively lose purchasing power every single year.
Right. So the market sells those bonds, which drives the price down and forces the yield up.
Exactly. And Thornton notes that there is currently a global uptrend in long-term interest rates.
Which is bad news for the Treasury.
Terrible news. The free market is looking at the $38 trillion debt and the structural inflation, and they are demanding much higher yields to hold long-term U.S. paper. The market is actively fighting the Fed right now.
But higher long-term yields are a literal death sentence for the Treasury. If they have to roll over trillions of dollars of maturing debt into new 30-year bonds at 6 or 7% interest, the entire federal budget is instantly consumed by interest payments.
Instant insolvency.
So how does the central bank stop the free market from demanding higher rates?
They implement yield curve control. The central bank publicly declares a hard cap on the yield.
They just dictate the price.
Yes. They might say, the 10-year Treasury yield will not be allowed to go above 4%. But to actually enforce that, they have to become the buyer of last resort. If the free market is selling bonds and driving the yield to 5%, the Fed has to step in and buy every single bond offered at the 4% price to artificially keep the yield down.
And where do they get the money to buy trillions of dollars of unwanted long-term bonds?
They conjure it out of thin air. As the source describes it, they must print.
Wow.
Implementing yield curve control requires an infinite, open-ended commitment to quantitative easing. It is the central bank entirely subsuming the bond market.
What's fascinating here is what that signals to the rest of the world. Because if the Fed implements YCC, it broadcasts a clear, undeniable message to every foreign central bank. The U.S. Treasury market is no longer a free market.
Right.
It is a manipulated construct sustained only by the active debasement of the underlying currency.
And the immediate consequence of YCC is the absolute cratering of the dollar's purchasing power on the foreign exchange markets.
Because the printing is infinite.
Exactly. Because you've capped the interest rate, the pressure valve shifts entirely to the currency itself. The dollar plummets, which means the cost of every imported good into the United States, most notably oil and manufacturing components, explodes.
Domestic inflation goes parabolic.
It goes parabolic. And gold, acting as the ultimate barometer of fiat failure, will reprice instantly to reflect the infinite printing required to sustain that yield cap.
Now, this is where Thornton moves from pure mathematical mechanics into human behavior and sociology.
Which is where it gets really dark.
Yeah, because when you have a system that is engineered to enrich asset holders while driving the working class into inflation-induced poverty, it creates a massive principal-agent problem.
The incentives are completely misaligned.
The source material brings up a conspiracy element here, explicitly discussing the idea that government monetary policy is largely dictated by power elites.
Right.
Thornton references the Epstein files as evidence of this highly insulated, deeply compromised class of influential people basically operating above the law. He argues that the average visitor has zero actual control over this financial leviathan.
Which feels pretty accurate to a lot of people right now.
And he points to the appointments of individuals like Kevin Warsh and Scott Bessent, noting their heavy involvement in the gold market, as evidence that the people pulling the levers are fully aware of the fiat collapse, and they are actively positioning themselves accordingly.
And look, when economists discuss the power elite, it doesn't necessarily require some smoky back room of cartoon villains.
Right. It's just human nature and incentives.
Exactly. It is the natural sociological outcome of regulatory capture and the revolving door between Wall Street, the Treasury, and the Federal Reserve.
It's a club.
The individuals appointed to manage the monetary system are entirely insulated from the consequences of their own policies.
So.
If you are a central banker or a private equity titan, you hold your wealth in hard assets, equities, real estate, fine art, gold. When you print trillions of dollars, your portfolio soars. You do not feel the sting of a 30% increase in the price of ground beef.
The incentive structure is entirely decoupled from the reality of the median wage owner.
Completely.
And this leads to an intense debate within the source material regarding the U.S. physical gold reserves.
Fort Knox.
Right. If these insulated policymakers realize the debt spiral is terminal, what do they do with the 8,000 tons of gold the U.S. supposedly holds from the World War eras?
It's the ultimate ace in the hole.
The interviewer asks Thorne if he thinks the U.S. might try to unilaterally revalue gold to a massively higher price just to magically wipe out the debt.
Which is a fundamental misunderstanding of market mechanics, really, and Thornton addresses this brilliantly.
He does.
A government cannot simply declare a new, vastly higher price for gold by fiat decree and expect it to solve a debt crisis. Price discovery requires liquidity.
Right.
If the U.S. Treasury declares gold is now worth $20,000 an ounce, that number is purely imaginary unless the Treasury is willing to actively buy and sell physical gold in unlimited quantities at that exact price to peg the market.
Which they absolutely wouldn't do because they would instantly be drained of all their physical gold by arbitrageurs.
Exactly.
But the source discusses a more drastic scenario. What if the U.S. actually starts selling off its World War II gold hoard into the open market to raise capital or defend the dollar?
It's just dumping it.
Yeah. Thornton says he wouldn't necessarily oppose it, noting it would temporarily flood the market and suppress the price of gold. But the psychological game theory of that move, it would be catastrophic for the dollar.
Absolutely catastrophic. The implicit foundation of the U.S. dollar's global hegemony rests heavily on the psychological comfort that the United States is sitting on the largest pile of sovereign gold in the world.
It's the ultimate psychological backstop.
It is. If the Treasury begins liquidating the family silver, so to speak, to pay the compounding interest on a $38 trillion debt, the illusion of impregnability shatters instantly.
It would be a sovereign admission of bankruptcy.
It would signal to the world that the U.S. has run out of options.
Which ties perfectly into the source's discussion of President Trump's stated desire for a weaker U.S. dollar. Now, I have to play devil's advocate here, based on mainstream political rhetoric.
Go for it.
A politician will go on television and argue that a weaker dollar is actually fantastic for the American working class.
You hear it all the time.
Right. The logic is that if the dollar drops in value against the euro or the yen, American manufactured goods, like our tractors, our steel, our technology, they become cheaper for foreign buyers.
So our exports boom.
Exactly. Our exports boom, manufacturing jobs return, and the Rust Belt is revitalized. Isn't that the exact medicine the downward arm of the K-shaped economy needs?
It is an incredibly seductive political argument, but it fundamentally ignores the mechanics of a globally integrated supply chain, and more importantly, the reality of domestic purchasing power.
Break down the actual mechanism for us.
Okay, let's look at it. Yes, a permanently weaker dollar might incrementally lower the cost of a U.S.-made tractor for a buyer in Germany. But the American factory worker building that tractor does not live in Germany.
They live in Ohio.
They live in Ohio.
Yep.
And their entire cost of living is denominated in dollars.
Right.
The moment you intentionally devalue the currency to boost exports, you simultaneously increase the cost of every single imported good that the American worker relies on. The price of crude oil, which is the foundational input for transportation, agriculture, and plastics, it skyrockets. The cost of electronics, clothing, and construction materials surges.
So the cost of living just explodes.
Exactly. The resulting domestic price inflation absolutely eviscerates the purchasing power of the worker's paycheck. Any marginal wage benefit they might receive from a slight uptick in factory orders is completely negated by the fact that their grocery bill just doubled.
Wow.
A policy of currency devaluation is, by mathematical definition, a policy of reducing the standard of living for the domestic population.
Okay, we have outlined a fairly harrowing macroeconomic reality here today.
It's definitely grim.
The fiat system is choking on $38 trillion in debt. The central bank's only escape hatch is infinite monetization through yield curve control, and the resulting inflation structurally impoverishes the working class.
That's the summary, yeah.
Naturally, any listener paying attention is concluding that physical gold is the only logical lifeboat. But right at the climax of the interview, Dr. Thornton throws a massive curveball into the thesis.
He really does. After spending the entire discussion meticulously detailing why gold is flashing red as the ultimate Tier 1 sovereign asset, Thornton pivots. And he reveals that he is actually significantly more bullish on silver.
Silver.
Silver. He even mentions wearing a specific silver-themed shirt for the interview and recently dedicating a full hour of his own podcast strictly to the silver market.
I found this pivot fascinating, especially when the host brings in the analysis of Michael Oliver.
Oliver is very respected in this space.
Right. Oliver is a technical analyst who applies an Austrian macroeconomic framework to his charting, and his models are projecting that silver could reach between $300 and $500 an ounce by the summer.
Which sounds insane to most people.
$300 to $500. For context, silver has historically struggled to break $50. But Thornton doesn't laugh this off. He explicitly states that he wouldn't be shocked by those numbers.
Not at all.
Why would a rigorous Austrian economist view a 10x explosion in silver as fundamentally plausible?
Because of the extreme hyperinelasticity of the silver market, driven by its unique dual nature.
Dual nature. What do you mean by that?
Silver is essentially schizophrenic in the commodities world. Historically, as Thornton notes, silver was the actual circulating money of the people.
Right, pocket change.
It was the trading money used for daily commerce, wages, and groceries, while gold was the investment money used by sovereigns and massive institutions.
But today, silver is also the most conductive, reflective, and essential industrial metal on the periodic table.
And that is the exact mechanism driving the supply crunch. The modern world literally cannot function without physical silver.
Like in electronics.
Everywhere. It is an irreplaceable component in solar photovoltaics, electric vehicle batteries, military guidance systems, and advanced medical equipment.
Wow.
And crucially, unlike gold, which is basically just hoarded in vaults and rarely consumed, the silver used in these industrial applications is used in such microscopic amounts per unit that it is economically unviable to recycle it.
Oh, so it just gets thrown away?
It goes into a landfill, it is permanently destroyed and removed from the above-ground supply forever.
Okay, so you have a baseline of industrial demand that is voraciously consuming the physical supply.
Yes.
And on top of that, you are overlaying a massive, panicking monetary demand from a global population trying to escape fiat debasement.
Exactly.
When you have a rapidly shrinking, unrecoverable physical supply meeting an exploding monetary demand wave, and the mining sector requires a decade to increase output, the mathematical result is an explosive price revaluation.
That is exactly why an Austrian economist looks at a $500 silver target and sees structural logic, not just technical speculation.
But Thornton is incredibly careful to append a philosophical warning to this analysis.
He is. It's an important caveat.
He makes it clear that simply acting as an individual speculator like, just buying silver at $30 and hoping it hits 300, that is not a systemic solution.
No, it's just a personal hedge.
Right. Getting rich off the collapse of the currency doesn't fix the societal rot of the K-shaped economy. He argues that the power elites, the Fed, the captured regulatory agencies, they are never going to voluntarily reform a system that disproportionately enriches them.
They have zero incentive to.
Systemic salvation doesn't come from the top down.
Which raises an important question about the agency of the working class in a manipulated economy, doesn't it?
It really does. What can people actually do?
Thornton, channeling the core mission of the Mises Institute, argues that the only viable off-ramp from this crisis is massive, decentralized public education.
Just teaching people how it works.
Exactly. The systemic mechanism of inflation relies almost entirely on the ignorance of the public. If the average voter believes that inflation is caused by corporate greed or supply chain glitches, rather than central bank money printing, the system just continues.
Right. The public has to understand the underlying plumbing. They have to recognize the difference between true free market capitalism, where prices are set by voluntary trade, and central bank cronyism, where the cost of capital is dictated by an insulated committee to benefit the asset class.
Reform only occurs when a critical mass of the population understands the monetary reality and actively withdraws their consent from the fiat system.
And for you, the listener, who is seeking a practical, immediate step toward navigating this transition, the source material explicitly highlights an educational resource.
Which is really helpful.
The host of the interview mentions a live webinar being hosted by Taylor Kinney. It's titled, Devalued Overnight, Protecting Your Wealth Through the Reset.
Sounds very timely.
It's scheduled for Tuesday, March 17th at 9:30 a.m. Pacific Standard Time. It's entirely free, it's live, and it includes a Q&A session to help individuals map out these macroeconomic shifts.
That represents exactly the kind of tactical education Thornton is advocating for.
Exactly. It bridges the gap between understanding the theoretical mechanics of the Austrian business cycle and implementing defensive strategies for your personal capital.
Because you have to protect your family first.
Right. So let's pull all of this together and really distill the absolute core of Dr. Thornton's warnings today.
Let's do it.
The US dollar, which is the gravitational center of global finance, is being crushed by a dual front reality. Global demand is actively collapsing as foreign central banks and citizens pivot to the safety of non-sovereign physical assets.
Like gold.
Simultaneously, the supply of dollars is being hyperinflated to service the compounding interest on a $38 trillion mountain of debt.
A debt that can mathematically never be repaid.
The central bank's attempt to paper over this crisis with artificially suppressed interest rates has engineered a malignant K-shaped economy.
Where malinvestment enriches the tech and asset elites.
Exactly, while the delayed tax of price inflation just completely hollows out the working class.
And gold is the ultimate objective barometer of this systemic failure. It is the canary in the coal mine, screaming that the math of infinite fiat debt has reached its terminal boundary.
And silver, caught between industrial destruction and monetary panic, may be the most explosive asset of the decade.
It really could be.
But the ultimate takeaway from this deep dive isn't just about commodity prices. It's about shifting your entire paradigm of risk.
That's the key.
Most people spend their lives agonizing over market risk. Did the stock market drop 2% today? Should I adjust my 401k allocation? But almost no one monitors dollar risk.
They're measuring with a broken ruler.
They fail to realize that their portfolio can numerically climb higher and higher, while the actual purchasing power of the currency underneath it is quietly evaporating.
Dollar risk is the stealth confiscation of your time and your labor.
It is the silent killer of generational wealth. And as we wrap up this deep dive, I want to leave you, the listener, with a final provocative thought regarding the foundation of this entire system. We discussed how a massive pillar of global faith in the US dollar is the psychological comfort that the United States is holding 8,000 tons of physical gold in depositories like Fort Knox.
Right. Gold largely collected during the chaos of the world wars.
The ultimate, unquestioned sovereign backstop.
Exactly.
Unquestioned.
Unquestioned.
Yeah.
So mull this over. What happens to the entire architecture of global finance the day that foreign trading blocs, or maybe the American public itself, demands a true, independent, physically verified assay and audit of that World War II gold?
Oh, wow.
Only to discover that the physical reality in the vaults has been hypothecated, leased out, or simply doesn't match the paper ledgers. If multiple parties hold paper claims to the exact same physical bar.
Exactly. If the gold isn't there or if it's over-leveraged,
Yes.
how much of our modern wealth, our 4% GDP growth, and our global stability is just a fragile illusion built on the ghosts of 1945.
That realization would be the absolute, irreversible breaking point of fiat trust.
It would rewrite the global order overnight. Thank you so much for taking this deep dive with us today. Keep questioning the consensus, keep studying the mechanics beneath the headlines, and we will see you next time.